We have talked about the acquisition when dissolution takes place. Now let's look at the acquisition method when there's no dissolution, or in other words, when both firms survive. So let's continue situation 2 from the previous example. BigNet pays $3 million to acquire all of Smallpot's asset and liability on December 31st. And then this $3 million is made up of cash, $1 million, and some unissued stock, which has a total value of 20,000 multiplied by 100 of 2 million. So, but different from before, to facilitate a future spin-off, BigNet maintains Smallpot as a separate incorporation, or in other words, in this situation, both firms get to survive. So, and the question is, first, what are BigNet's journal entry to record the acquisition of Smallpot? And secondly, what are the consolidated financial statements right after the acquisition? Please take 5 minutes. Try to work on it on your own. And we're going to go through the example. You can pause your video for now. So let's first look at what is BigNet's journal entry. As we mentioned earlier in today's class, BigNet's journal entry, when there's no dissolution, we only need to record everything into the investment account. We don't need to record Smallpot's asset and liability separately into BigNet's book. So the journal entry we make is we debit BigNet's investment account by 3 million and credit common stock 200,000. So we have 20,000 shares multiplied by 10 per share par value. We credit additional paid-in capital for 1.8 million. And then BigNet also paid cash 1 million. So this journal entry should balance. This is BigNet's journal entry. And then let's look at what does BigNet's book look like after recording this journal entry. So most of the accounts are not affected. Those accounts are not affected. And then current asset is decreased by 1 million. So the resulting balance is 100,000. Investment account is increased by 3 million. Computer equipment, those accounts are not affected either. And total assets now becomes 4.9 million. Notes payable is not affected. Common stock goes up. Additional paid-in capital goes up. And BigNet's asset and liability total assets and total liability and shareholders' equities should be equal. So this is BigNet's book after the recording the journal entry. And then what we do in consolidation is we take BigNet's book after recording the journal entry at acquisition. So if this is 1, and then we combine it with Smallpot's book. We combine consolidation entry S and A. And that will give us the consolidated total numbers. And one thing to pay attention to is small parts book. So we listed those amounts here, but you don't need to worry about those amounts because here we are only doing the consolidation worksheet on the date of acquisition. So on this date, small parts actually, it hasn't generated any net income for us yet. So we cannot, all of those income generated by small parts, those are generated before the acquisition. So we don't need to combine them in the acquisition. So the only thing we need to worry about is small parts balance sheet. That is what we need to combine. And let's look at consolidation entry S. The purpose of S is to eliminate small parts shareholders' equity account. So specifically, we use it to eliminate common stock of small parts. In order to eliminate a credit side of common stock, we debit 100,000 common stock. And to eliminate additional paid-in capital, we debit 20,000 additional paid-in capital. To eliminate retained earning, we debit 480,000 for retained earning. And 100 plus 20 plus 480, that adds up to 600,000. So we credit investment account for 600,000. This is consolidation entry S. And for consolidation entry A, what we do is to mark up small parts, assets and liability from their book value to fair value. So which asset and liability that small parts has, which has a difference between fair and book value? First of all, it is computer and equipment. Also, we have capitalized software, customer contract, also notes payable. So in order to mark up the assets and liability from book value to fair value, we debit computer equipment by 200,000, which is the difference between fair and book value. Debit customer capitalized software by 1.1 million. And debit customer contracts by 700,000. We credit notes payable by 50,000. So those journal entries this is to mark up small parts book value to fair value, but is it enough in this situation? So let's look at this situation. The total consideration transferred is 3 million. The total net book value of small parts is 2.55 million. So the difference here is 450,000. And out of this 450,000, part of it is due to the difference between fair and book value of small parts net identifiable asset and liability. So specifically, we have computer and equipment. The difference is 200,000. Customer capitalized software, the difference is oh, sorry, this is not, this is the fair value. So the net book value is 600,000. Sorry. And then we have capitalized software. The difference between fair and book value is 1.1 million. Oh, so, and here the difference is 2,400. For customer contract, we have a difference between fair and book value of 700,000. And notes payable, the difference is 50,000. So what are the totals here? So we have 2,400,000, but the difference between fair and book value that we can allocate to identifiable asset and liability, this only sums up to 1,950,000. And then there's another there's another 450,000 that we cannot identify, and this is allocated to goodwill. So here in this situation, actually we need to recognize markup also the amount of goodwill of 450,000. And then 200 plus 1.1 million plus 700,000 plus 450,000 minus 50. So the total, in order to make this journal entry balance, we need to decrease investment account by 2.4 million. So this is consolidation entry A. And then for the consolidated total, we add up big nets book, small parts book, consolidation entry S and A. And the thing we need to pay attention here in this situation is we don't need to worry about small parts, any of its net income before the acquisition. So for the revenue, we just carry over because we don't need to worry about small parts net revenue before acquisition. So we just use big nets revenue, which is 1 million. And the expense, it is the same thing, 800,000. So if we take revenue minus expense, that gives us 200,000 net income. And this net income is carried over to your statement of retained earning. On the statement of retained earning, beginning retained earning 870,000. And then dividend is 110,000. So if you add them up, if you do it vertically, retained earning total is 960,000. And this amount is carried over to your balance sheet. So on your balance sheet, now we need to add up everything horizontally. Current asset, big nets current asset is 100,000. Small parts current asset is 300,000. So the total current asset is 400,000. Investment account 3 million minus 600,000 minus 2.4 million, that goes to 0. Computer and equipment 1.3 million plus 400,000 plus 200,000, so that gives us 1.9 million. Capitalized software 500,000 plus 100,000 plus 1.1 million, so that gives us 1.7 million. Customer contract, that's 700,000. Goodwill is 450,000. So if you add up everything vertically, you are going to get a total asset, which is 5.15 million. And then it will do the same for the liability side. So for liability, big nets have notes payable of 300,000 plus 200,000 from small parts on its book. And then we're going to get, here, so This number should go. And then we need to plus 50,000, which is the difference between fair and book value. So the total is 550,000. Common stock adds up to 1.8 million. And additional paid-in capital is 1.84 million. So if you add up everything vertically, that will give you 5.15 million as well. And then these two numbers should equal. If it doesn't equal, that means there's something wrong. Your balance sheet, your consolidated balance sheet should balance. So this is what we do under the second situation when there's no dissolution. When there's no dissolution. And then, I'm not going to compare here, but please take 1 minute, just compare yourself, the two worksheets, the last column of the two worksheets. And you're going to find that those two columns will be exactly the same. So, and again, consolidation when there's no dissolution should lead to the same result when dissolution takes place. Those two situations would give you the same consolidated total numbers. So we have talked about the two situations when dissolution takes place and when there's no dissolution. Then we are going to look at 3 specific costs associated with business combination.